Hey everybody, this is Sean from Not Financial Advice. Today is Thursday, April 18th. The market is closed, and today we're going to be talking about five stocks that are down about 10% or more as the overall market is in a bit of a dip or a pullback nearing 5%. So, this can be a great time to go on a bargain hunt looking for underpriced stocks for future returns. And so we're going to talk about those five stocks. We're going to dive into everything right after this.
You need to diversify your bonds.
The only problem you're going to have is that you didn't buy more. Because by the time you read about it in the Wall Street Journal, it's already too late.
All right, so quick update on the portfolio. Market was down 0.22% today. My portfolio had relative outperformance, down just 0.16. Some of the things that were working for me today were these top companies up around 2 to 3% here, here, and here. And then we can also see the companies that did not do so hot for me today. We can see several companies down around 2 or 3% as well. There, and there. So that covers it for the update on my portfolio. But let's dive into these companies and remind ourselves of where we're at. So the market currently is down about 4.7%. That would be in a dip or a pullback territory. It's not a correction. A correction is 10% or more. And so just seeing how resilient this stock market has been and how explosive its growth has been since October of 22, you can see it up nearly 40%. So many people say that a 2 or 5 or 7% pullback is a good time to enter the market. But can you get even better deals looking at individual stocks? And so we're going to start off today analyzing Home Depot, which is down about 20% from all-time highs. We can also see here how powerful of a performing stock this has been. And so is it something that would be interested in buying? Let's go through everything here. I'll ask you to like the video, subscribe to the channel, and we can see here a forward PE ratio of 22.4, healthy free cash flow yield of 5.3. And we can see its dividends are looking healthy, 2.7% payout, less than a 60% payout ratio. So we're going to do a speed run on evaluating these metrics. Top line revenue up nearly 7%, thumbs up. I'm just going to keep my thumbs up for efficiency's sake because free cash flow is up about 11% a year over the last 10 years. That's absolutely fantastic. Earnings per share up about 15% over the last 10 years. That's great. Cash and debt. They've got a lot more debt than they have cash. So that'll be a thumbs down. Looking at dividends, it's a high dividend yield at a fairly safe level, growing at 17% a year. So like 5xing inflation over the last 10 years. Big thumbs up for dividends. Sorry, my arm was getting tired there. We can do it again. Shares outstanding, massive repurchaser of shares. They buy back 3.5% of their shares each year over the last 10. Thumbs up for not diluting shareholders. Looking at ratios, return on capital employed in this low to mid 40 range, massive. Big thumbs up. And bottom line profit margins. This is a heck of a story. So nearly 9-10% on bottom line profit margins. Home Depot as a company is winning, even if their stock price isn't. Can you see the disconnect? So historically, they have a low valuation compared to what they've traded for in the past. So we're going to give that a thumbs up. And let's dive into some technicals on this stock. Keep in mind that technicals are basically astrology for dudes. But what we can see here is the price is broken down under its 20-day moving average. It's above its 50-day, and the 50-day is above its 200-day. So looking pretty solid there. Like the video, subscribe to the channel. We're going to go on to our next stock, which is, in fact, McDonald's. I'm going to mix it up. I want to see the price first. So we can see the price on McDonald's stock. It looks like it's down just around 9% from all-time highs. And we can see that this is definitely a power stock, a blue chip in its own rights. So looking at its performance over a longer period of time on the financial side, similar to Home Depot here, folks, 21 forward PE, 3.6% free cash flow yield. And then you have that same high dividend yield over 2.5% at under a 55% payout ratio. So they're going to get dinged here on top line revenue growth, which is not growing. Although, depending on if you want to torture these numbers, they've done well in raising prices with inflation over the last 4 years. I think their new Cosmic brand will be good for top line growth, but they do earn a thumbs down there. So you may or may not even consider it based on that. But if we look at free cash flow growth, it's up about 5.33% over the last 10 years. That looks really solid to me. We're going to take a look at earnings per share. Fantastic. Top line, or rather earnings per share growth, 7.6% over the last 10 years. That can definitely drive stock prices higher, as we saw there on its all-time price performance chart. So a thumbs up here. Same sort of deal with Home Depot. They have more debt than cash. It's not great, but the dividends are a thumbs up, growing at twice the rate of inflation, where those cash and debt levels are a thumbs down. So moving forward, they have a great track record, a very long track record of not diluting shareholders, buying back shares over the last 10 years, over 3% a year, thumbs up. Looking at ratios for McDonald's over the last 10 years, or all time rather, they have returns on capital in this 20% range. So big thumbs up there. And a similar great story on bottom line profit margin, hovering over 30% over the last few years. We're closer to about 30%, which obviously is a big improvement from back in these times. So a thumbs up there for that as well. They're trading at a discount to their historical PE valuation, earning a thumbs up. And now we look at the technicals on McDonald's. Let's take a look at it together. Prices under its 20-day and its 50-day, but above its 200-day. So we can see that picture clearly there. Like the video, subscribe to the channel. We got 3 more to do, and we're going to go fast. Make sure that we always respect your time. This one is Apple. So this is a little bit of a controversial one. I actually have a bit of a hot take, but 26 forward PE, free cash flow yield of 3.7%. A lot of room for dividend growth here. So they pay 0.6% dividend, but it's at less than a 15% payout ratio. This will be a stock that in the future pays 2 or 3% dividend yield. And so yield on cost could be crazy starting from today, hypothetically. But the question is at a 26 PE ratio, is this company growing? And some people say that growth has stalled. Sure, if you look from that quarter to that quarter, but I don't really agree with that narrative. So over the last 10 years, Apple's top line growth has gone up by 10.1%. It had been accelerating at about 15.6% over the last 5 years, but you can see it sort of going back to a mean reversion to its longer term growth rate. So its trajectory of increase is not at as much of a magnitude, but they still are growing. So I give them a thumbs up. I don't buy into that narrative that Apple is a dying company. Free cash flow over the last 10 years has been nearly 8%. The growth on free cash flow is a thumbs up from me. Looking at earnings per share, this drives stock price. It's up a lot, 16% a year over the last 10 years. Thumbs up on earnings per share. Now they have a better cash and debt position than the previous 2 companies. Is that worth the PE ratio? Looking at dividends, growing at like 2.5 times that of inflation, up 8.2% over the last 10 years. And then we are going to look at the price chart here. I'm getting a little bit jumbled, but you see signs of a maturing company here, accelerating its share repurchasing down nearly 5% a year. Thumbs up. They don't dilute their shareholders. Ratios are going up. They've got just insane returns on capital employed in that 50% range, which is nuts. And the bottom line margin growing, holding steady around 25, 22%. So a thumbs up there. Now, so we don't get confused, let's take a look at the price chart. Obviously, it's been a great performing stock over all time. But as far as where it sits today from all-time highs, down about 15%. So is that a buying opportunity? I give you the information. You are the judge of that. But yeah, down about 15%. And then lastly, We do have the historic valuation sort of in a middle range, so I give it sort of a meh rating. Technicals on Apple, we can see here, as in all of these previous charts, we're looking over the last 2 years. We see the price below the 20 and 50-day, and you're seeing the 20-day is about to slip beneath the 50-day moving average, although the price is higher than the 200. So, whatever that means to you, but now you have that data. And then I'm going to ask you to like the video, subscribe to the channel. We're getting in on our last 2 stocks, and the last one I'm saving the best for last. But JP Morgan, one of the best banks of all time. Let's look at its all-time price performance. That looks like a good investment. So as far as its fall from recent highs, it's down about a little bit over 9.5%, so close to 10%. Okay. On a really strong, powerful blue chip stock. That's definitely something worth taking note of. And we can take a look at their book value, which is 1.7, free cash flow yield of 4.3, payout ratio of 26% on a fat 2.5% dividend. So the dividend growth looks good for this company. Revenue nearly 5% a year in this more value sector is a thumbs up. Free cash flow isn't really the main way that banks are analyzed. So we'll look at earnings per share. Those are always nice, up 14% a year over the last 10. Thumbs up for earnings per share on JP Morgan. More respectable cash and debt position, more similar to Apple. Very high quality company here with the pristine balance sheet. Looking at dividends, they cut in the GFC, but over the last 10 years, they're up about 12%. I'll give it a thumbs up. Looking at shares outstanding, do they dilute shareholders? No, they do not. Down about 2.6% over the last 10. Thumbs up there. Look at the bottom line profit margin. So like 30%, which is more than 20%. So thumbs up there. Let's see what else we can see. Okay, moving forward. Their historic valuation for price to book, this is something that a bank is judged on, is sort of in the middle of its range. So that's going to be a big thumbs up from me. All right. Like the video, subscribe to the channel. We're going to take a quick peek at the technicals here on JP Morgan Chase. We're going to be looking at our last stock, which is Ulta Beauty, which I'm super excited about. This has the best looking chart of them all. Price above the 20-day, 50-day, and those two moving averages above the 200. Now, the best for last, Ulta Beauty. Let's take a look at its all-time price performance. So pretty aggressive looking stock, strong performance, down, about 26% from all-time highs, 22%. See if we can zoom in on that a little bit more. Okay, down about 25% from all-time highs. So is Ulta Beauty worth 25% less than it was 6 weeks ago? Probably not. Let's take a look here, Ulta Beauty. So bam, real nice low PE for this market, 16. Free cash flow yield, huge at 5% almost. And let's see what else we can see. Top line revenue growth, 15.5%. The only time it went down is when people literally had to put a mask over their face. But apparently some people were still buying makeup. So great top line revenue growth numbers. Free cash flow on Ulta Beauty, mega super high. Free cash flow growing at 28% a year. We can also see earnings per share just smoking about 24% year on year. Thumbs up. Earnings per share growth driving stock prices higher. Not sure what's going on with that. We're going to breeze past it. They don't dilute shareholders, buying back about 2.6% a year. That's great. Thumbs up. Also looking at ratios up and to the right on return on capital employed, sitting around 40%. Just nuts. Big thumbs up. Profit margin, thumb staying up around 11% versus wherever it used to be. So historical valuation on this company also appears to be lower than average. It is. This is the one that I like the most. All right, guys, this is Sean, not financial advice. Hope you got some value out of this. Getting some stocks added to your watch list, being opportunistic, being greedy when others are fearful. This is not financial advice. I'm Sean. I'll see you on the next one.